A vast generational divide is opening up between wealthy young investors and wealthy older investors. Robert Frank is here to explain this. We've been paying a lot of attention to behavioral economics depending on the age cohort lately.
Yeah, and there is a huge difference between these two age cohorts. Nearly 3/4 of millennial investors and Gen Zers surveyed said they won't be able to get above average returns with traditional stocks and bonds. That's according to a new study from Bank of America Private Bank. Now, most investors over 44 still have a lot of faith in their stock and bond portfolios, so there's a big difference there. Now, when asked about the best opportunities for growth, this one's just interesting. The younger investors listed real estate first, followed by crypto, and then private equity. Asked the same question to older investors, domestic stocks topped the list, with real estate and then emerging market stocks right behind that. Younger investors have nearly 3 times more alternatives in their portfolio compared to Xers and older investors, and they have about half the share of stocks. So younger investors, only about 25% in stocks. Another big difference is collectibles. The young wealthy are nearly twice as likely to collect watches, classic cars, and wine. And I know Sarah knows this. Nearly a third of them are collecting sneakers. Very few of the older investors are. Now, older investors say they collect because they enjoy it and they rarely sell. The younger investors see collectibles as part of their investing strategy, and they're much more likely to trade in and out of their collectibles. You can read a lot more about how the wealthy are investing and this great wealth transfer that's going to make these younger investors even more important to the stock market. You can read all of that in my Inside Wealth newsletter at cnbc.com/Inside Wealth, or click on the code with your phone.
Is it your guess that this is sort of standard youth risk tolerance, or does this generation, having lived through COVID and existential questions about climate, think about the world differently?
It's absolutely about the formation of their life experience when they became investors. And there's interesting, Josh Brown talked about even within sort of Gen Z versus millennials. Millennials, remember, started investing right before the financial crisis. Probably many of them lost money in stocks, had a long road back, so they're very skeptical of stocks. For that reason, Gen Zers are skeptical because they have so many more choices of where to invest than we did or our parents did, where it was just 60-40. And, you know, even collectibles, you can buy a share of a painting or a wine fund. And so there's just, each generation is different, but it's a vastly different landscape for these younger investors than it is for the older investors.
But Gen Z has not been through any major correction.
That's right.
In any of this collectible, crypto, any of it. And
so there you have almost an overconfidence in markets, where I think some of that you've seen in the meme stocks, you've seen it showing up in different exuberant parts of the market. But because they have a much wider choice and a distrust of traditional institutions and traditional investing, they want to go far afield to crypto and collectibles and alternatives, private equity and real estate.
You know, the irony is that one of the big long-term bull cases for stocks is that millennials are going to turn 50. And when the boomers turned 50, it was the 90s tech bubble. It was a demographic you had to own assets. And we'll see if that actually is the irony in all this.
And even if it's smaller shares in stocks, because $80 trillion is going to pass to younger generations in the next 20 years, there will be a ton of money with these younger investors, and that's why this matters.